Global oil majors are pulling back from aggressive drilling as tumbling crude prices trigger sweeping cost cuts, job losses, and shelved projects. Companies such as Chevron, BP, and ConocoPhillips have announced thousands of layoffs, while state-owned giants including Saudi Aramco and Malaysia's Petronas are also scaling back. Brent crude has halved since its 2022 highs, trading under $66 per barrel, forecasts suggesting it could fall below $60 in 2026. Analysts warn that at this level, most Western producers cannot sustain both investment programs and shareholder payouts. Meanwhile, capital spending is projected to fall 4.3% this year, raising concerns of delayed projects and reduced output. The sector now faces subdued prices, cautious investment, and mounting pressure on oil-dependent economies. Adebayo Adebanjo, Investment Associate, Research and Strategy, Cardinalstone, joins me from Burundi. Hi, thank you so much for joining me today.
It's a pleasure. Thank you to be.
Well, this is a report that categorically says oil majors are scaling back on drilling. Is that something you can attest to? And can we say the same for Nigeria?
Yes, absolutely. Like you said, globally, we've seen a dramatic shift, scaling back on drilling. We're also seeing job cuts. Companies like Chevron have cut about 8,000 jobs. British Petroleum has cut about 4,700 jobs. And I think ConocoPhillips has also cut over 3,000 jobs, right? These are clear signs of, retrenchments. And like you said, also, the U.S. shale patch is slowing as well. And break-even prices for U.S. shale is around $65 per barrel, which is, slightly above where Brent is currently trading, right? So it means that the economics no longer make sense, for Western oil producers, right? And, when you say the same for Nigeria, not really. In Nigeria, I think it's a bit nuanced for Nigeria because what we're seeing locally is that, while some international operators have slowed down their upstream activity, on onshore assets, like because of issues around, insecurity, and theft, at the same time, we have been seeing very selective commitments. For instance, right, the federal government just signed the first of its kind production sharing contracts with Total Energies and Sapetro under the PIA framework, right? And this shows you that, while oil majors are very cautious, they are still willing to back projects with, attractive fiscal terms, projects that have long-term value, especially in gas and other strategically attractive deep water blocks and assets. So I would say that it's not quite the same, relatively, also because cost of production in Nigeria is somewhat lower than shale production. So I think that Nigeria still has a bit of buffer, to maintain production at current levels.
All right. Now, we're looking at a three-pronged reaction here. I mean, except Nigeria, maybe. We're seeing cautious drilling, cutting costs and jobs. And of course, projects are also being shelved. What are the likely implications of these if they continue?
So in the short term implication would be less supply growth, right? Like you already said, CapEx spend is forecasted to fall about 4.3% this year. And this is going to be the first decline that we're seeing in CapEx spend since 2020, according to Wood Mackenzie. So this means that, some barrels which were supposed to come online in 2025, around 2026, will no longer come online. The second thing is the social impact, right? Tens of thousands of jobs are being cut, like I said, and it's not just in Houston or in Aberdeen. Also in local supply chains, from steel pipe makers to rig service companies. So the entire value chain of the oil and gas industry is going to be hit hard by these reactions to lower oil prices. And so we might see even steeper, job cuts in other secondary services, right? So for Nigeria, I think that lower upstream activity will limit government take and FX inflows, right, which is a challenge as far as the fiscal side of the government is concerned. But it also underscores the importance of diversifying into, gas and, accelerating domestic refining, which is something that the PIA is very, very serious about, right? So we think that while these challenges are largely Western, they are the overarching global problems I don't necessarily see it happening in Nigeria as such. In fact, if you look at the financials of some oil majors in Nigeria, local players, we are seeing increases in, in salary payments. We're seeing increases in staff headcounts. So it kind of the reverse is happening here. And I think because the fiscal framework is improving, the PIE is, allowing for better clarity as far as the oil and gas sector, is concerned. So these implications will largely be global, but I don't see them happening yet in Nigeria.
Well, looking at what you talked about, but we're not seeing, these companies being rewarded on the NGX. I mean, what do you think?
Sorry, I didn't get the question.
Okay, so you're talking about how that here in Nigeria, companies are reporting good financials and all of those. But since the beginning of the year, I don't think, investors have rewarded the oil and gas sector. Why is that? When you look at what's happening on the Nigerian exchange.
So to a very large extent, because the market is cut across the upstream and the downstream players, right? And at the moment, we don't have a lot of upstream players in our markets, say for the likes of Seplat, Wando, and Aradel, right? And for those companies, the factors affecting them are quite different, as you're aware. For companies like Aradel, for instance, we think that the market is not exactly pricing in the company's core fundamentals. If you look at the company's earnings, so far as of half year, companies recording stellar performance, across its own core businesses and increasing income from its associate businesses, right? But we're not seeing the market react positively to that, and I think that that's because of the companies listing from the NASD and coming into the NGX, right? And if you look at how the share price of the company had performed on the NASD coming to the NGX, investors are kind of cautious of taking positions. Also, prior investors that had the stock on the NASD are still in the money as far as the share price is concerned. So any small volatility we see on the NGX would not affect such investors as such. So we think that for the likes of Aradel, there has to be a change or a shift in the composition of its investors who will be looking more to fundamentals. For the likes of Seplat, it's largely investors being cautious about looking at how the acquisition of MPNU, now SEPNU, is going to affect the overall business. And interestingly, Seplat is going to have a capital markets day today, where the management will be giving us insights into its plans for the next 5 years. So I think that whatever they tell us there would also guide investor sentiment as far as how they're looking at Seplat going forward. For Wando, really the issues have been largely around corporate governance, the timing of reporting its earnings and the quality of the earnings as well, which has affected investor sentiment. So I think that even away from the global issues, there are some, inherent challenges that, these companies are facing that are affecting our own, markets and investor sentiment as such.
Right, now let's get back to the global issues. Now, oil prices, I mean, how are the mighty falling? What exactly is going on? And for how long are we going to have this?
Well, I mean, yes, oil prices are falling very badly this year, and it's largely a demand and supply challenge. Largely, it's back to fundamentals. If you look at how oil prices have trended for the most part of the year, it have been driven largely by geopolitics, right? But it looks like fundamentals are back in focus. And so on the supply side of things, you'd see that the OPEC has reversed much of its post-pandemic restraints. So it's now actively adding back barrels in order to defend market share. If you look at the data, you see that the US has been the biggest oil producing country for right, and I think that Middle Eastern countries like the UAE, Saudi Arabia are trying to get market share back from the US, and that is what is also informing this rollback of prior production cuts that we saw in the pandemic times. Also, on the demand side, China's growth has kind of been underwhelming. Europe has been sluggish for a while. And like I said about the US, inventories are on the rise. So all of these factors put together are affecting, oil prices. In fact, when you look at data from the US Energy Information Agency, they expect global production to average around 105 million barrels per day this year. And it's also rise to around 106 million barrels per day in 2026. That's for production, but consumption is going to be around 103, 104. So when you see that there's an imbalance in production and consumption, right? So supply outweighing demand typically, and given the expectation that still will persist even into 2026, is what is affecting, sentiment at the moment. And so the EIA is projecting, Brent prices are probably going to end the year around $68 per barrel. And then going into 2026, we might see Brent come down to around 50 levels. And, that's really the expectation.
50 levels, isn't that scary? All right, I thought you were going to say something.
Well, I mean, it is scary. I mean, but I think that a lot of companies already have hedge positions that would protect them from this kind of material slide in oil prices. But again, these are just expectations, going into 2026. And as you've known, there's a lot of difficulty in projecting oil prices as such. Geopolitics could come back into the fore, which would affect, prices as we're going into 2026. But again, the extent of the forecast that we have now is based on the extent of information, that we have. And I think these forecasts will be updated as more information comes going into the future.
Absolutely. But I mean, I do not pray for that. But in the event that that happens, how do you think Nigeria will be able to, hedge against all of that, or even navigate that path?
Already seeing it affects Nigeria to some extent. If you look at the trade data that we saw as of half year this year, we saw crude production rise by about 13%, but we saw a decline in crude exports. That's in Naira terms. We saw a decline to about, about 24 trillion, coming from 28 trillion year on year. So it's a combination of higher production and lower export value because of, pricing. So what I think is, because pricing is out of the country's control, the factor that they can control is output. So I think that Nigeria will have to ramp up production much more rapidly, right, in order to capture, the pricing at every point in time, in order to maintain, the fiscal balance, because really, oil income is very, very material. And even though we're seeing, the non-oil exports proportion of our trade balance double as of half year this year, which is very, very commendable. We think that, we still need to keep an eye on oil income. And, while prices are likely to downtrend going into next year, I think output will be the way to go. Output has to rise materially in order to cover the shortfall.
All right, Adebayo, I'd like you to just hold on for a bit. We'll go on a very quick timeout, and when we come back, we'll continue the conversation. Thank you so much. Glad to know you're still with us, and I still have right here with me Adebayo Adebanjo, Investment Associate, Research and Strategy, Cardinalstone. Thank you so much for staying with me, Adebayo.